listening to The Mortgage Scientists, exclusively on the Pod Station.
Hi, I'm Dave Forrest.
I'm Chris Hume. Together, we are the Mortgage Scientists.
Hello, Chris.
Hello, Dave.
Episode 7.
It is episode 7. We've marched into March very, very quickly, haven't we?
March 26. It only seems like 2 minutes ago we had the bells and the whistles for Christmas, doesn't it?
It does indeed.
So this episode, we're going to look at the mortgage market, the house market in general, I suppose, with it coming towards the end of the tax year in April. We could start off with, we're both really busy at the moment in the mortgage market, aren't we?
We are. A strange start to the year. January was a little bit flat whilst people found their feet as we came into the new year, and February seems to have absolutely rocketed.
Yeah.
The number of properties that have been listed on the market, I think, is reported to be pretty buoyant.
Yeah.
Certainly we've had a number of clients having offers accepted, which is phenomenal as well.
Yeah, I think I've found, and I don't know whether you're the same, there's a lot of existing clients looking to move now. Are we in a cycle where some equity's built up?
I think we are. I think there's a significant number of 5-year fixed rate mortgages ending this year. I think people are now looking at that scenario where do they stay where they are or do they look to move? A lot of that is dovetailing with choosing locations for schools and catchment areas and that kind of thing, and obviously job and career opportunities for people as well. And a lot of these things can have a big impact on that decision to move or stay where you are.
Yeah, I think you're right. And there's a lot of trigger points, isn't there? There's so many things that happen. Interest rates have fallen a little bit. Certainly if we were sort of 2 or 3 years ago, we've covered that off a little bit over the last few episodes. But we're now getting to start with interest rates at 3 and 4%. It looks a little bit better, doesn't it?
It certainly feels better. And I think that's where people's confidence is up a little bit, because inflation reported now to be on the right trajectory. The Bank of England seems to be a little bit happier with things. The indications are that we may see further cuts from the Bank of England this year, but, you know, there's a lot of water to go under the bridge before we get there.
Yeah, as we stand at the moment, as we record this, we're just before Bank of England decision in the next couple of weeks, so we'll see what that happens. Some predicting that it will drop. We've just had a hold, haven't we, in the previous one?
We did, and that was a fairly sensible decision, but it was a close vote with members of the Bank of England whether to keep it as it was or to reduce. But I think the pressure now is to reduce further, stimulate growth a little bit more.
And I'm sure you're the same. If there's a Bank of England meeting, 12 o'clock on the Thursday that it happens, your phone goes crazy,
Glued
doesn't it? Yeah, because everybody wants, if there's a Bank of England reduction, can I have a better rate? Well, it doesn't always work like that, does it? Because lenders either react before or they wait and they react after, but it doesn't all happen at 12 o'clock on the Thursday, does it?
Lenders like us, they're kind of thinking what is likely to happen. They have some fairly bright economists that know this stuff far better than we do. They've already analysed where they think Bank of England and market rates will go. Generally, they've already priced in that reduction or that change in rates or that holding rates. They've already priced it into their mortgage products. Just because the Bank of England does drop on a particular day doesn't mean that lenders will then react straight after it, unless, of course, the Bank of England surprises us all.
Yeah, you just never know. For lenders' point of view as well, that obviously the way they fund their mortgages, they'll bring that money in at a certain rate at that time, so until that's used up they can't really do too much to drop it too much, because then they're all of a sudden out of kilter, aren't they, with the way they've bought that money. So it might be they've got to get rid of that before they can get some in at the lower rate.
I mean, ultimately lenders are there to make profit. They want to lend the money out at more than they've borrowed it in at, whether that's from other markets or their own depositors saving money with them. Lenders are also spending a lot of time pricing their mortgage rates on their appetite to lend. So it's not just about the market rate or what the Bank of England is at or what they can borrow the money at. It's how interested they are in lending the money to us given the overall economic situation and their capacity with their teams of underwriters and mortgage centres to actually process mortgages.
Yeah, I was going to say service is a big key, isn't it? Been around a long time. We know back to the days of 8 weeks to look at an application. We even go back to when things weren't online and we were doing paper applications. Lenders just can't get through the work. That tends to be a bit different now because lenders have got technology to deal with it. But you do start to see, especially now as things ramp up, things get busy, lenders do just slow down a little bit. And that comes into their decision then on a product, doesn't it?
It does. And as well as tweaking the rates that lenders will offer, they will also tweak their criteria to suit the type of lending that they want to attract. So from our point of view as brokers, that criteria process is changing all the time. And that has a fairly balancing effect on the market as a whole, because you generally find that the high street lenders, there's always someone up there trying to get new business in, and they have this little bit of a dogfight between each other month after month as to what they want to achieve.
Yeah, no one wants to leave themselves out there on their own with the most amazing rate products or whatever that we're all using, but then you can't use it.
Yeah.
Go back to a good few years ago now. Remember, we used to have to stay up till 12 o'clock at night, let the clock tick over to 12 o'clock, and then more funding was available for lenders. Thankfully, that doesn't seem to happen anymore, does it?
Far better controlled now. There are a number of lenders that will give us at least 24 hours notice of withdrawing their products or changing their rates, which is a lot more comforting from the point of clients having the option to take the time to make a decision on a recommendation that we've made, rather than it being a snap decision on an afternoon when you've had an email at 4 o'clock and the rate's going at 5.
Yeah, you've got 4 applications to submit in an hour, I know, or you're staying up till late trying to submit them. So we're in February, coming into March. So in January, anyone out there may want to see our little video we did. We were down in Haydock at our networks. They call them the kick-off of
meeting,
event.
yeah.
Whether that's a good name or not, I don't know. The start of the year, isn't it? We always do it. All of brokers get together. And we have a few people on there who'll give us predictions on what this year will look like. And they tend to be sort of economists from big lenders and stuff like that. What did you get out of that from what you think the year's going to do in mortgages and housing and all that?
I think there's still a lot of quiet confidence in the housing market, and there's a lot of talk about things like AI and where that might feature in things. But whilst AI is good at some things, it can be fallible in giving incorrect information. And I think that's where, as an industry, we're aware that AI is out there, and it's something that we embrace as an industry, but we're just cautious not to embrace its failures and inaccuracies. So that was one big thing that came out of where the future lies in the longer term.
Yeah.
But in the short term, I think the economists are generally quite confident. As we said earlier, there's a significant number of people coming off 5-year fixed rates this year. Those 5-year fixed rates started with a 1% something typically. It's now good that we're seeing mortgage rates generally for the lowest rates starting with a 3 point something rather than a 4 point something.
Yeah.
And hopefully, as the Bank of England announces the rates later this month, we may just see more lenders in that 3% territory.
You've also got the mixture as well of people coming off the 2-year fixes where they were 5 and 6%, haven't you? So there's a real mixture this year where we're going to be seeing some people a little bit happier and some people having to change things a little bit.
We're just going to go to a commercial break. We'll be back after this short message.
Do you have a passion, hobby, or expertise and want to share it with the world? Why not do a podcast? The Pod Station offers a wide range of packages to make this a reality, ranging from training and support for those who have no idea where to begin, to podcasters who just need somewhere to host their show. With prices starting at a mere £15 per month, you can now get involved in one of the fastest growing entertainment forms in the world without all the headaches. To find out more, visit thepodstation.co.uk/station-packages. And remember, those with passion, podcast. This episode is sponsored by Dunkin' Biscuits, a biscuit lover's guide by Chris Hugh.
Yeah, I think the interest rate shock could be a good shock or a bad shock.
Yeah.
Certainly where you're coming off a 5 point something or a 6 point something, you're going to be very pleased with where the market has reached and where it could be going. Where you're coming off a 1 or a 2% something, I think you definitely need your broker's help in managing where the budget may sit going forward. We're there to help advise and guide on what you can do to manage things still being comfortable on that mortgage commitment.
Yeah, and then you've got the sort of housing market. You get those predictions, don't you? Well, the housing market's slow or the housing market's busy. I think it still is a bit of a north-south divide, really. In London, maybe, and the south, property prices may be stagnant or even dropping a little bit. But certainly, I think in the northwest, you're starting to heat up a little bit. We're up in northwest. First-time buyer can still find a house for 200, 250, maybe. With wages have gone up a little bit, so I'm finding, obviously, that's reasonable.
Affordability is starting to get a little bit easier. Some lenders are easing their affordability criteria as well. The regulatory aspects behind affordability have also been helpful. But again, whilst a lender may lend you 4 or 5 or however many times an income in simple terms, it's not always wise to borrow the maximum that you can, because you still have to make it affordable on a monthly basis. And again, that's where your broker will help.
We're all doing it. We're still using affordability. We're stress testing a little bit because, again, we're talking about rates falling, but they can go up. We always have to caveat that, don't we? We've been around again a long time. We've seen them go up and down so many times. But people do say, are we ever going to have 1% again? And we sort of say, well, I don't think so. And we don't think so.
Pending disaster.
Pending disaster. disasters, yeah. As we say, we think probably Bank of England are going to settle somewhere this year, maybe around about the 3% mark, or then on top of that, what the lenders provide, you'll be talking about a 3 or maybe a 4 if you're in a specialist area or something like that. So
yeah, in a perfect world, we would see the Bank of England settling in that sort of early 3% mark, and maybe mortgage rates in and around a similar, but that's not to say that other disasters from a worldwide scenario may not put pay to that. It really is a difficult one to decide, and I think that's where, as a broker, we're looking at how a client can maybe insulate themselves from those external effects on what their mortgage payment might be. So yes, we might have an idea on what may happen in a perfect world. We maybe need to insulate ourselves against the imperfect world.
Yeah, and also we don't cover it on here, but there's loads of things can happen politically, can change things, can't they? I suppose from where the market would maybe heat up is if there was a decision made over something like stamp duty, which is always a topic that comes up in the budget area. It doesn't look like that would probably change too much over the next couple of years, I don't think, do you?
Again, it's a difficult one to decide because obviously the government's got the new build house target. They want to encourage first-time buyers not only to want to buy, but to be in a position to buy. There's so many different mechanisms available to governments and policymakers to help the market. But sometimes you've got to wonder about the law of unintended consequences of some of these things. There may or may not be changes to stamp duty, but I don't think you can bank on things getting better in that respect. So again, you've got to make the decision at the time you want to make the move.
Yeah, it's quite interesting, isn't it? If you've got something like that, like stamp duty, and if you're making that second move where we are, you're probably moving to the 300, 400. Stamp duty becomes a little bit more cumbersome, but it's sort of what it probably does is put house prices up, because people price that into the house, don't they? They say, well, the house will pay for it, puts house prices up, and then puts the next one up. It's sort of like a never-ending circle where they keep just going up, don't they?
Yeah, it can be. And again, different areas will fare differently depending on the local factors. And one of them is building housing estates as to what the prices of new builds go for in local areas and how that has an effect on the local market. So again, there's so many different impacts on what house prices are and what they might be. I think there's an element that house prices are still going up, albeit very, very gradually. You look at some of the key lenders that report on house prices, they're seeing house prices still going up 0.7, maybe 1% in a month. Yeah. But then you look at the other influences in the market, so right moves of this world that see the house prices at the listing stage, they're also reporting that house prices are going up. So you're seeing that the housing market at the different stages of its evolution, and it's all in positive territory.
Yeah, you've also got the remortgage market, obviously, as well, where people are coming off those rates we were talking about, the 2 and the 5-year fixed rates coming to an end. And then people are saying, oh, well, my house is worth X. The lenders' systems will keep up with house prices, and sometimes you look at one and go, that's quite high, or that was quite low. But obviously, when we're doing a remortgage, we'll come up with a figure where we think the price is. And if generally that's going up, that's all data that goes into the market as well, and possibly pushes prices up too.
Yeah, absolutely. And I think this is where you might see sort of online house price indicators, I won't name any, giving you an idea what your house might be worth, but that's based on some very loose information and publicly available data. The lenders have far more accurate data through their surveyor teams of actual valuations of properties. So lenders are a lot more accurate when they're doing the remote valuations. Yeah. Take the online stuff with a bit of a pinch of salt, get some advice on the value of your home and plan accordingly.
Yeah, I mean, there's loads of tools out there you can use, as you say, or you've got your local estate agents who are quite happy to give you a valuation and stuff like that, what your house is worth or what they think it's worth. I mean, I suppose our mantra is always, if you need anything, you always go and see your broker, because they'll have access to people who can help you with that. And again, it's all about advice, isn't it? You covered AI just before, but we've talked about this, haven't we? Sitting down with someone and getting some advice off a human being is probably never going to end, is it?
It's phenomenally personal when we sit down with a client, because we're taking out all of the noise of everything else that's out there and personalising it directly to the client's circumstances that are in front of us. And I think that's where you get the best result. AI may give you a direction, but it won't pinpoint and refine.
Yeah, fantastic. So I would always say, have a chat with your mortgage broker. If you haven't got one, find one who can sit down with you and give you some good, honest advice about, you might be moving, might want to raise some more funds, funds, whatever you want to do with your mortgage is just have a good sit down and talk about it.
Yeah, plan where the future feels like for you and your family, and maybe have a look at how you can take out a lot of the adverse external influences that may put your budget in jeopardy.
It's about affordability, isn't it?
Yeah.
We always talk about future-proofing it. You might be able to make a move that you don't think you can make. I'm constantly speaking to clients who don't think they can actually move, but then when you look at it, they can.
Yeah, there are some nice surprises out there as well, aren't there, Dave?
Yeah, there are. I think that's it, Chris.
I think it is. We've covered quite a bit of the market. I think there's a long way to go. We'll soon find out how accurate we were, won't we?
We might come back and tell you we were totally wrong. Yeah, pitch predictions, but hey, it's got to be caveated, isn't it? You just never know.
Yeah.
Fantastic.
Looking forward to the next one, Dave.
See you on the next one.
Enjoy the rest of the month.
To find out more, email info@themortgagescientist.co.uk.